Well, good to be here as
Wowee, sir.
always.
Yeah, pay in 8, they reckon, is the new competitive advantage of Zip.
It took you 3 seconds.
Zipco, ASX, ZIP, one of the world's greatest companies. The AFR says, and this is
Had a
what I'm
massive
reading,
run in the last few weeks.
it says Zip nails comeback, predicts huge US transaction growth. This is from James Ayers, senior reporter at the AFR. Drew, as a shareholder, and are you still using Zip?
No, I use Afterpay actually, but not Zip.
Oh, wow, what a transition.
I think Zip is for bigger purchases, to my
Yeah, it is
understanding.
kind of like white goods and that sort of stuff.
Yeah, flights.
Yeah. Will
surgeries probably.
Will it continue to make a comeback?
Well, actually, I thought it tanked this week, but it's up over the last 5 days, still up 11%. I did tank when it reported, dropped about at least 10%. I just keep looking at the year result. It's up 300%. So I reckon, is that outperforming Nvidia this year?
Let's have a look. Next Nvidia, big
quietly.
Call. But it could be.
Yeah, it's doubling the performance of Nvidia. So there you go.
There you go. So everyone around the world will be talking about this $3 billion buy now, pay later company called Zip.
Is that anchoring bias that if, I held it from $10 to 50 cents and now it's gone from 50 cents to $2, but if you put the chart at the right time, it looks like I'm a genius.
So wait, I'm just bringing for people that are watching on YouTube. So you bought it. When did you buy it? Like you bought it early days, yeah?
I bought it twice.
Okay, I'm pretty sure you said something like $4 back in the day.
I bought it like 2018.
Okay, so that would have been
once.
So that was the first purchase. So let's say 70, 80 cents. Go on.
I sold it at the first peak in like $9 here in the next one. That one of those ones there.
Yep.
And then saw it run again to like $13.
Yep.
Let it fall from that part, like as you do. Caught the falling knife. Like could not have played this any better.
It's like $6.
Yep. Caught the falling knife.
And then it plummeted down to 50 cents. But now it's back to $2.38.
And it's around my original purchase price, probably.
Yeah, so, investing isn't linear.
Luckily, I've got that dividend yield they've been paying.
Yeah. Well, yeah, it's very profitable business. So that's keeping you company, I guess. But
they don't pay a dividend
at all. I don't even know if they've ever been profitable. They probably have been profitable on an adjusted net basis with once-offs removed. But yeah, okay.
Similar results to what Nvidia did this week too.
Tell me how. No, legit. Like, tell me more about this.
Well, I think growing off a low base is probably a benefit of Nvidia, but Nvidia is no longer growing off a low base.
Mm-hmm.
You see their profit increased by almost 300%.
Nvidia, you mean?
Or nearly 200%. Went from 6 billion to 18 billion in a quarter.
Yeah.
And their margin is eye-watering. So their margin dropped from 78 gross margin, so basically their profit margin before some other expenses, from 78 to 75%. That's a serious margin.
Well, when you're one of the only companies in the world that does what you do, and you are probably in the the structurally most important technological revolution of
in modern history.
Yeah. You're going to do pretty well. It's super scalable business. Do you own Nvidia shares for disclosure?
Not directly, but through multiple actively managed funds, ETFs. Munro would be one. FANG.
Oh, you saw Munro present this week, didn't you?
Yep.
What was the
got some feedback from it. Yeah, it was great. I mean, Nick Griffin from Munro is probably one of the best tech investors. I think we said this before. If you're looking at Australian investors that understand sectors, it's definitely tech. And Nick, early identifier of things like Amazon, even Nvidia. I remember him talking about how Nvidia was going to be the biggest company in the world like 4 or 5 years ago.
Does he still hold that view?
Even when it was struggling, there was a time when you couldn't get enough chips, and everyone thought they were cyclical, and that was like 800% returns ago. And I mean, it is now like the 4th biggest company in the world.
Yeah, and growing super fast. Like you said, with the profit margins, it's really hitting that inflection, and it's just well. Now, you did promise us on the show last week, for regular listeners of Dr. Andrew Dermuth, they would be familiar with a promise that you did make to us last week, which is that you promised to take us on a journey through real estate investment trusts to give us the kind of inside scoop from. Actually, I'm not going to even let you get to that right now. You got Waddle Partners Waddle Day tomorrow. Tell us about this.
We do.
Yeah,
and I'll be hosting the trivia. We'll be doing trivia during. We're filming on Thursday, and this will go live on. So it was actually yesterday. I'm looking in the future now.
Whoa! Inception moment. So we're recording this on Thursday. Everyone's listening to it on a Saturday. That means yesterday in their time,
we did Waddle Day.
Is Waddle Day. So what if they came along to
the Waddle Day is actually on Sunday. Even more confusing.
This sounds like
National Waddle Day is the first day of spring.
First, of course. Yes.
And historically, Waddle started blossoming in the beginning of spring. Now it blossoms like from May onwards. But as you probably know, we have a bit of a community of retirees and people thinking about retirement. So we're taking about 60 or 70 people out down to the Mornington Peninsula for lunch. A bit of a sculpture walk, some Waddle trivia. So some
Waddle is in the plans.
Yeah, I know some interesting things about our team at Waddle.
Right.
There's one about
what's my How many predictions has our in-house economist made? Yeah, these types of things.
That's a new title I need. And what's my favorite food? So I'll let you know. I might bring that one to the potty next week.
That's
You'd be surprised.
Is
it caviar? Is it creme brulee?
It's probably the master food eggs, seasoning,
everything. I can't get it anymore.
Everyone that listens to the Australian Investors podcast went and bought that egg seasoning, and now it's out of stock. Woolworths is limiting customers. One thing
they put those security things on it.
One per customer, and everyone just rushes in. What's really? I've really noticed it this year. Everywhere I look, there's a Waddle. I don't know.
I know
if you guys did that on purpose.
That's similar to us, doesn't it?
Everywhere I look, there's just Waddle plants, and I'm like, oh gosh. So anyway, just quickly, because I know some peeps that are going along to this Waddle Day. You kind of is it just more like a catch up for like clients?
Yeah, it's pretty casual. So we've tried a lot of things over a lot of years, and we've found that delivering investment content and wine at the same time aren't really conducive to a good time.
They're not.
So basically, this is almost like network. It's just networking for our clients and the opportunity to get to know our team better and get to know each other and other people that are part, either clients, prospects, and part of our community. So it's
you're saying that wine and finance does not mix.
Investing. So getting too detailed on investing and drinking wine. The ultimate outcome is an emoji with ZZZ on it.
So what you're saying is, I like how you guys have made this decision. So you've said wine plus investing is not a good combination. So what we'll do So what we'll do is remove the investing. And just do the wine.
Yeah, I mean, every day they'll still get the daily update from us in the morning, so they'll still know what's happening in markets, and they'll get their monthly and quarterly. So plenty of investment communication, and there will be lots of questions, I'm sure. Might throw in a couple of NVIDIA updates during my trivia, and we'll see how that goes. But looking forward to it.
Yeah, fair enough. That's good. Now, back to this REITs thing that you're going to take us through. First of all, what is a REIT? REIT. What does that mean?
Real Estate Investment Trust.
Okay.
And there are A REITs, so Australian Real Estate Investment Trusts, and G REITs being Global Real Estate Investment Trusts.
Okay, so they're like a global thing.
J REITs, Japanese Real Estate Investment Trusts. You can probably put any letter you want in front of it at any time. Z REITs, Zambia. Not that I've ever invested one in a Z REIT, but
Zimbabwe. I was just trying to think Zambia. What? While you explain to us so you're going to cover like what is you just covered that, but like the basics of REITs and how to understand them, and then you're going to bring a bunch of examples and tell us about their recent results through the lens of those terms which you help us understand. So
really put myself under pressure here.
So just tell us, like I can kind of prompt you. I'll stand in for everyone listening and watching. So let's start at the top. What are the key terms that people need to know if they're going to look at a real estate investment trust?
I think one of the most important by far is the net tangible asset value. And this pops up as NTA. And as the name suggests, it's the true value of the underlying assets. So if you look at something like Goodman Group, we want to bring up the share price of Goodman Group, all right. So to be defined as an A-REIT, you actually have to hold a significant amount of property, and that the entity has to hold property. Most real estate investment trusts own some property themselves, but then also manage property for other people, or in other cases, develop property either for themselves or other people.
So Drew, let me double click on something. So we should have made this apparent at the start. So a REIT is a type of trust because that's in the name, and it invests
it's a trust, not a company,
in property. Predominantly, that's what it does. It invests in property either in the development of property or in the ownership of property.
And management of property. It's like a listed landlord in a lot of examples or a lot of situations where essentially they own and rent out the property for you.
So for people that are watching on YouTube and we've been talking through this, we've just got up Goodman Group, which is the biggest one in Australia, as far as I'm aware.
It is by far 63 billion or thereabouts.
But now we all trust Google Finance for our life, just like we trust ChatGPT these days. It says here that the dividend yield is 0.91, which seems really low for what I understand for REITs. So typically these have higher yields, right?
I think let's go with Vicinity, actually. Let's switch to Vicinity. I think this is a better one to...
Okay.
Goodman does a lot of development and has partnerships, so it gets a little bit more complicated.
Yeah. Okay. So Vicinity Centres, VCX.
Yeah.
Is the ticker symbol.
The big one here is probably when you said it's a trust, not a company. That means it doesn't necessarily pay fully franked dividends.
Okay.
It actually makes distributions, and a trust is similar to an ETF or a managed fund in that it distributes profits each year. And the profits, it's not a company structure, so it doesn't have a franking credit balance. But then there is a thing called stapling, and it's probably something that we might try and cover in this as well. But you're receiving distributions, not dividends, which have different tax implications than holding shares in CBA.
Yeah. Okay. So a REIT is a trust, like an ETF or a managed fund. It has to push the income and the capital gains and the taxable position back to the investor. That's why it's called a distribution, not a dividend.
Exactly.
But it earns a lot of rent, so that can be really good for income purposes.
And depreciation. So anyone that holds property knows that if you get negative gearing, and negative gearing sometimes comes through non-cash things like the depreciating value of your land, your fixtures, and fittings, and that's on another scale with these. So Vicinity, as an example, is the owner of things like Chadstone, and I believe Chatswood in New South Wales, and then a whole heap of other city and kind of regional shopping centres.
Yes.
So major, anyone that knows Melbourne knows Chadstone. You can't miss it. Drive past it. The key things you want to know about Vicinity. First thing is the net tangible asset value. So the net tangible asset value reflects the value of the properties that trust, that A-REIT or that REIT owns. Okay. And what you're looking for, and what we always look for, is that if you're going to buy something like, in a similar way to listed investment companies, where they'll have a net tangible asset value, which is the value of all the shares that they own on your behalf. The net tangible asset value of Vicinity at the most recent announcement was $2.30 per share. I'm hoping this is reflected in what you've got there.
$2.30 per share. Yeah, I've just got the. It's probably not going to show that, but yeah.
So that's the value of the properties. Usually, you pull it up in the best place to get that is in the results, not in the presentation, because the presentation can be really long. And as you can see, the trust is trading at $2.16, which means it's trading at a discount.
So the share price is just under the net tangible assets, or the value of the properties.
Nearly 10% below the value of the properties.
Okay.
And that can be for a few reasons, but that's one of the first things you want to look at. Are you buying at a discount to the value of the underlying assets? And then the second question would be, why is it trading at a discount? Do they expect the value of those assets to fall? Is there something wrong with the company? Do they have too much debt? All those kind of questions start to come up. But net tangible asset value is probably one of the most important.
At risk of having a digression in the middle of this REIT presentation, I did happen to Google the Zambian stock market while you were doing this, and this fellow came up. He looks like he's doing the shucker, and he's got like a bunch of hyperinflated bake bills in the side here. But the Zambian stock market, just for those of you that are curious, looks like it's trading under the Lusaka Securities Exchange, LUSE. So if that was not I don't know, it wouldn't be Z REIT, it would be a LU REIT, whatever that is. A LU REIT. Okay, back to the REITs.
All right, don't digress. You're supposed to keep this online.
Okay, so net tangible assets, go.
The next thing you want to think about after net tangible asset value is probably funds from operations, or FFO. As
FFO, yeah.
FFO would be how that's generally reported. And then there's adjusted FFO, or adjusted funds from operations. And effectively, your funds from operations is the cash flow that is produced by running the core operating business of Vicinity, for instance. So that's how much rental are they getting in, what are their expenses, and what money's left over. And you'll find in the majority of cases that the distributions are very, like 90 to 100% of funds from operations. Such is the nature of property in these trusts, that they have to distribute most of the income as it comes through. So you want to see, and I mean, it's probably good looking at it now compared to looking at it during the pandemic, because we know that, funds from operations were all over the shop for any sort of shopping centers, office properties, because rents were, some rents were being paid, some were being deferred, some were being credited, and it was very difficult to measure that. And there's been heaps of movement on that.
One of the questions I got last night while I was at Ho Chi Mama eating some delicious food was, I got a question.
Did you get a free meal?
No, I did not. But Ho Chi Mama, if you're listening, we do like free food. One of the questions I got was, what happens if a trust doesn't send like we keep saying that a trust, like a REIT or an ETF or a family trust, any of these things called trusts, they don't send the money on, like they don't distribute, as you're saying. What happens? Like, why wouldn't they just hold on to it?
Generally, income that isn't distributed from a trust is taxed at the highest marginal rate.
So about 47% or something crazy.
Yeah.
Right. So that's like a kind of like a tax requirement. And I believe in the US it's also kind of like a legal requirement to distribute income in the G-REIT space. So basically all around the world, these trust things are just what you would say is a pass-through entity.
Yeah, exactly. There's a bit more complexity in terms of the staple. You can have a stapled trust where they staple a company and a trust together. And that's like a legal structure. That probably gets a bit too complex for this one, where you can have a portion of dividend and a portion of distribution.
Would that be like people that are familiar with, say,
Westfield
Transurban?
used to have it. Transurban, yeah. They're kind of stapled securities where you've got one that owns the asset and one that owns the operating company. And then you get like this blended distribution. But starts to get pretty complex when you get there as well.
Okay.
So we've got net tangible asset value, we've got FFO. The next one would be, we've talked about distributions versus dividends. The next one I'd probably look at is capitalization rates. So I ran into one of my mates who's in property leasing and sales this morning, and he was talking about how cap rates are all over the place. So capitalization rates are basically a percentage rate that's used to value a property. So what is the income return that you're getting when you purchase a property at that value?
So is this kind of like for people that are
a yield almost?
Yeah, like a yield on a bond. Like if people go to a bond fund or ETF website and it says yield to maturity, is that kind of the thing that they're looking at?
Yeah, it's like if the rent is 50 grand and you're buying a property for $1 million, the cap rate 5%.
Yeah. Okay.
And what you've seen, and everyone talks about it in the media, is that you've seen cap rates going out. And this is important because if term deposits have gone up and you bought a property that was yielding 3% when you bought it, but term deposits are now at 4%, and someone believes they need to get a 5% income from the property that you're trying to sell, or the value of that is going to be 40% lower than what it was before, because it's to get the same yield from that rent. The value of the property has to be
because
lower.
It's like kind of like dividend yield. If you're saying that if you buy a stock and it's like really high share price, you're dividing the dividend payment by the stock price. So you're saying that's a lower yield. In order for the yield to go up, the stock price has to come down.
Exactly. So how do you go from, is it easier if I do 4%? Yeah. So let's say you bought it on a 4%. This is going to be, and you got 40,000. This is going to be very difficult for me to do off the top of my head. You're getting an income of $40,000 on $1 million property. And now the next buyer thinks that they need to get a 5% yield because debt's higher. They need that income to be closer. How would I do this divided by
800,000?
800,000. Yep. So they're only willing to pay $800,000 for the same property that used to generate that you bought for $1 million.
Yep. So that you're saying that the cap rate's really important because it's that calculation which blends those two things together, the yield effectively.
Exactly.
And the only thing that can really change is the purchase price of a property.
Yeah. I mean,
the rent stays the same.
A bit, but it goes up 3 or 4%. It goes up with inflation or even less in some cases.
Right.
Or it falls because you have to give out discounts to get people to go into your property.
Yeah.
But cap rates is essentially what's been moving and what's been driving the initially poor performance of REITs and then the stronger performance. And the interesting thing is because these are listed products or listed trusts, they actually trade every single day. So if as soon as interest rates go up, A-REITs tend to fall, and as interest rates are expected to fall, A-REITs tend to go up. Whereas if you compared it to unlisted property, so things held by industry funds, by all the big groups, they're not valued every day. They're more likely valued every 6 months or year. So they get bigger chunks of the cap rate isn't applied over, isn't reassessed every day like it is on the market. It's only reassessed when the underlying assets are really valued. So it might be your property falls by 20% on 30 June when you get a proper valuation. Whereas if you're in a REIT, it would have fallen by that period, by that amount during the year, or by a similar amount.
Yeah. So the REITs are kind of adjusting every day, and that's effectively what's happened. Like that's the difference between that and the actual fund thing that you can go onto the website and purchase.
Yeah, exactly. And it's seen as both a positive and a negative. Like if you're investing in property, you're doing it for the long term, so maybe you're not as worried about how often it's valued. But if your property is going to be worth less, you want to be able to, like you and I probably want to be able to buy it cheaper if we can. Okay. So it's always that mix of benefits for either.
Can you talk to me about a REIT that you've mentioned a few times on the show, which is the Charter Hall Long WALE REIT? So if someone was to just look at this REIT, it trades under the ticker symbol CLW. And I know a lot of people own this REIT, and one of the reasons is for the yield that comes from this particular REIT. But another reason that people like this one, aside from Charter Hall being pretty respectable property managers, is the thing that's written in the title of it, the name of it, which says Charter Hall Long WALE REIT, and WALE is spelled W-A-L-E. Can you educate us?
It's not like Owen at a casino where he's a whale and just throwing the money around like James Packer.
I wouldn't be there very long.
WALE, I think there was an extra term that we had on here, is defined as weighted average lease expiry. So it's almost similar to the maturity of a term deposit, but this is the weighted average of when your leases are due to expire. So if you've got a property that represents half your portfolio and it's got a 15-year lease on it, and you've got one that's represents 10% and it's only got 5 years left, this is a calculation of how long on average till each of your leases come up. And that's important because when a lease comes up, all kinds of things can happen. You have to release, you have to refine, sometimes you have to refine tenants, sometimes you have to refit and spend a lot of money on property. So your WALE is quite important. And in a lot of cases, it's seen as a longer term guaranteed income in the form of that rent.
So longer equals better because it's more locked in revenue.
It depends on what you're looking for. Generally, you're going to get it can depend on the underlying assets, but your income can be lower given the length of your lease in some cases.
So if you locked in a lot of leases, say a couple of years ago when interest rates are really low, you might have locked in a low rental return.
That's why it can be bad in those cases. Yeah.
Yeah. So here we can see on the screen in front of us, we can see that the CLW, Charter Hall Long WALE REIT, it's also just a normal trust as well. It doesn't have to be a REIT, this one. 5.8 billion is what they're saying is the property valuation of all the different properties. It's got 540 properties.
That's always, that's an important one, that you're buying this one thing on the ASX, you get 540 properties behind it.
And these are not like Drew's house, even though probably is spectacular. We're talking about like office properties, or in this case, I think it's got some petrol stations, some logistics hubs, that sort of stuff.
Yeah, so they got 22% of their rent comes from Endeavour, so Dan Murphy's and bottle shops, and they're obviously there's an ethical for some people, whether they're comfortable with that. 19% is to government or Ozpost. 12% BP and service stations. There's some Metcash, there's some David Jones, there's some Bunnings, and there's some big corporates like Woolworths as well.
Okay. So of all of those properties, 540 of them, they're saying that they've got 99.9% occupancy, which is a really good sign because it means that the properties are actually being used. Because I've been chatting to some people around like Sydney CBD, especially around the fringe of Sydney CBD, or even Melbourne CBD around the fringe, and they're talking about occupancy rates in some properties of like 40%, which means that there's 60% of the offices or spaces aren't being used. So to have 99.9%, what we tend to find is, correct me if I'm wrong here, Drew, is that when it comes to commercial properties, whether it's warehouse, office, whatever, the really A-grade properties, they tend to always
have a problem.
They are always good, but then it's not like a normal residential property where anyone would buy the shack down the road. It's like you're either in the best property or you're not going to go near it. And that's a big difference with commercial properties. Like the A-grade is truly A-grade, and then it drops away quickly. So they're saying 99.9% occupancy and 10.5 years weighted average lease expiry, or WALE. So that's a long time, and they're measuring it in years. So they're saying we have a lot of tenants, a lot of properties with a lot of tenants, and most of them are on really long-term agreements. So
not many gaps.
Yeah, so they're saying we've got good clients, a lot of properties, they're all filled, and they're on long-term agreements. So invest with us because the income's probably going to be consistent.
Yeah, exactly.
Okay, that makes sense.
And then I think in most of, like, I've written down the notes on about 4 or 5 of the biggest REITs, and what you'll see in most cases is occupancy is like 95% plus. Because if you look at the Dexus, the Charter Halls, the Vicinities, they're all managing primarily A-grade, high-quality assets.
Yeah,
it's when it falls off out of the top 10, 20 that you start to see higher occupancy and more difficulty in tenancies.
Okay, probably a question I should have asked at the top of the show, seeing that we're talking about flowers and global warming affecting the wattle plants.
You said it.
Do you use REITs in the Wattle Partners portfolios? Like, does Atchison use them? Do you guys use them? Like, talk to me.
Yeah, so REITs are, I think, an important part. We separate into sub-asset classes. So while they're listed on the ASX, we put REITs into what we call real assets asset class. So that REITs go alongside infrastructure. There's very similar characteristics to infrastructure. So they provide pretty strong cash flow. They're highly expensive to replace, a lot of these assets, and they provide diversity of income. So you're getting income from rental payments from a much broader group of companies than if you just hold shares in the banking sector, for instance. So they do go in, but there is a bit of a challenge that comes with investing in REITs in Australia. And as we know, and as you invest as well, we suggest the core satellite approach, particularly once you get to retirement. So Vanguard VAP would be the most popular, I think, or STW would be the State Street, and probably one of the oldest. But VAP, so Vanguard Index Property Securities Fund, which tracks the S&P A-REIT from memory.
Yep. Okay. I'll say it with yes. Yes. Yes, it is. Yes. The S&P A-REIT 300. Yeah.
300 A-REIT. The problem with this, which is something you have to be comfortable with, and it's something that applies to most indexes, is that there's only 33 holdings in VAP. And because of the sheer size of groups like Goodman Group and Centre, which owns Westfield Shopping Centres, it's very highly concentrated. So Goodman Group's 37% of VAP. So essentially, you're making a pretty big tilt or bet that Goodman Group, which has a partnership with Amazon that does logistics and industrial warehouses, will continue to grow at a rate that has in the past. And it's always been a problem with property securities, because before them Westfield was in a single trust, and Westfield was a significant part of the index as well.
So Centre Group owns the Westfield,
most Australian of the old Westfield assets, yeah.
And so if you invest in the VAP ETF, what you're saying is you get effectively 49% of your VAP ETF is just in these two things.
It's 65% essentially in the top 5.
Wow, that's really concentrated.
It's more concentrated. We talk about the ASX or the S&P being concentrated, but that's even more concentrated.
Yeah,
So
you're saying you wouldn't have just this in a retiree's portfolio.
Not alone. You generally combine this with an active manager within REITs, or in another case, you'd combine it with some active management in global property securities or global REITs as well. Because that you can see here that you're getting a lot of exposure to the industrial property sector. In REITs generally only invest into commercial property, industrial, logistics, healthcare, office buildings, retail, less so into residential, unless they're apartment blocks. So you're not necessarily getting that diversification. So we'd always say core satellite. You start with an index exposure and you complement it with active management around it. And you can tell, like, what you want if you're trying to outperform the index is something that's highly concentrated like this and has the potential to be, and the ability to be quite different. So if you just held an equally weighted portfolio of the same stocks that were in this, your active share would be significant. And the potential to outperform would be significantly higher.
So, but you got to be careful, Drew, because a lot of ETF providers listen to this podcast. They're probably listening there. Wait, did you say equal weight? Yeah, equal weight. Yeah, let's do one of those. So, so starting next week, the
patent pending.
The equal weight REIT ETF. But seriously, like, so you combine this type of a thing. You do divide it up into sub asset. Like, you want to know, is it industrial? Is it retail? Is it whatever?
Yeah.
And then try and blend those together.
There's different ways to do that. So you can hold that, and then you can hold Vicinity, SCG, Dexus, or something else directly as a stock.
Yeah.
And that gives you a tilt the same way. Same way we think about Aussie shares or global shares. If the index is really, really highly concentrated, then we're trying to find ways for our retiree clients to smooth that, to smooth the experience rather than relying on a single company.
So, okay, I got one more question for you then, which is, why would someone use a REIT rather than just having a property, like just owning a property?
Because liquid.
So you can buy and sell it quickly.
You can buy and sell it whenever you want. You get the benefit of income. You still get the benefit of depreciation because you're getting tax deferred or tax advantaged income when it gets paid out. And in a lot of cases, you can buy this portfolio of 500 properties at a discount to what they're really worth.
Okay.
And that's very difficult to do in direct property. And naturally, the income is more diversified.
Okay. This actually leads us into a question that we did get sent in. We'll come back to company reports in just a moment. But
we've got questions.
We got questions. Yeah, obviously, if we answer your question on the show, we don't know your personal circumstances, your needs, goals, or objectives. So be sure to refer to a financial planner, like, say, Mr. Drew Meredith here. He's a CFP, which stands for something that he can cook in the kitchen. No, it stands for Certified Financial Planner, if I'm not mistaken. And you'll find a link to financial planning by going into your podcast player and into the show notes. There's a URL that you can click on. Or you can just email drew@wattlepartners.com.au if you're in retirement. Here's your guy. The reality is we don't know your circumstances. So when you do send in a question, we do appreciate you just making it a bit funny and kind of mixing it up a bit, and it makes it easier for us to answer. And if we do get your question on the show, I'm sure Drew would be happy to share a book with you. The Golden Years, How to Retire Early, Guaranteed Investment, I think is the title. But there was a question sent in from, you can call me Pop. Bad boy Bubby reference.
Billy Bob Thornton, isn't it?
Not related to finance, just popped into my head. This is what they said. So I'm just reading it verbatim. If we just read everyone's questions verbatim, it would be hilarious, to be honest. So they say, "G'day, Owen." I should say Drew as well, but no worries. Just finished listening. Oh, no, because it was just finished listening to the chat you had with Dion Hershon from Yarra Capital and his comments about looking outside the top ASX 20 companies. I would like to get your take on this, given that the A200 ETF from Betashares or the VAS ETF from Vanguard have often been spoken about as forming a major component of a core investment. The lack of future growth and the limited diversification of the banks and iron ore miners has made me rethink if a product such as the X20, which is from Betashares, there's also a similar one from Vanguard, may be better suited to a core portfolio. Could you please discuss this? Now, Drew, I'm going to throw this to you first. How do you think about the concentration? Because you were just talking about REITs being like there's a lot of concentration there. But how do you think about that in terms of the Australian share market as well? We've got BHP, CBA, that sort of thing.
Yeah, I think we think about it exactly the same way. Like the concentration may not be 65% in 5 stocks, but it's more like 50% in 10 stocks, and really in 2 different sectors. You got traditional banks and you've got mining. So we've long been proponents of the getting diversification outside the top 20 companies. And we've done that. We kind of look at it in different ways, that we want an exposure to the medium-sized companies. I mean, these are still generally large that fall into X20, and then we want exposure to the smaller companies, but we want that in a more diversified manner. And in our for the type of clients we work with, investing into X20 companies directly is incredibly difficult because there is less of an informational edge. These companies are less researched, and holding them individually, they're going to be more volatile. So what we've always tilted towards either an ETF or active management to gain that diversification. And the big part comes back to that. You can income plus growth equals total return. So you can get a great chunk of income. You can get a lot of income by just focusing on the top 20. Your bank's resources are going to give you a 5-6% yield, but we need to balance growth both globally and in Australia. And we know, you can't expect banks are mature, grocery retailers are mature, and mining companies are cyclical. You can't expect consistent year after year earnings growth from those. You can find quality earnings growth in companies outside the 20, and lots of it if you need to. So we've, long proponents of X20.
Okay, so long proponents. So you're blending that both in active positions and passive positions with the broader market as well.
I think generally there aren't a lot of options in X20, and such was the nature of the market that the index did pretty well, but you kind of then expose yourself to the same risk that your sector allocation can be quite can still be quite concentrated. So in probably the last 3 or 4 years, we've tilted very much more towards active management, and that's shown, like, as you can go to the S&P website and see that everyone will talk about that 30% of large cap managers underperform the index. That increases, we talk about this all the time, as soon as you go mid and small cap, the percentage of managers outperforming their index increases significantly because the universe of investments increases, and there's an informational and research edge. So we will generally blend either an index or direct stock portfolio with active managers. And full disclosure, we've invested in the Yarra fund as well.
Oh, I was going to ask that. Okay. Yeah. So okay. So in the past, you've invested with the Yarra Capital one, which is Dion's.
Something, to be careful of is knowing that I'm not sure if we talked about style before, that there are managers.
Not much. We should do a deep dive on style.
Oh, God, you're setting me up for the next one.
We got to wear something good.
But there can be a value manager and a growth manager. And as we know, momentum can drive performance in short periods of time. So you want to know when you're investing in an active manager, are they looking for cheap stocks and mining stocks and cyclicals, or are they looking at growth stocks like WiseTech, Xero, all those kind of high growth technology companies, or are they neutral to all that? From memory, the Yarra fund aims to be style neutral, so they don't get caught out if the market turns. And you can see that. I'm just looking at, that's the X20 portfolio, but you've got something like Brambles alongside ResMed, alongside Northern Star, which is a gold miner.
Yep. So I'm going to do a bit of pop trivia then with you. And what I'm going to ask you for is just to limit your answers to the ASX 20. So this is your hint, right? So I recently did some analysis on this, which was it was great that we could speak to Dion at the same time that I was just looking at this stuff. So I did a post in the Rask community, which anyone can get. I'll put it in the show notes. So what is the company in the ASX 20 with the fastest growing dividend over the past 10 years?
Fastest growing dividend. CSL.
Fortescue.
Ooh, I just paid out 2.2 billion to the Forrest family this week. So
compounded at 29% per annum.
Imagine the tax on that.
Yeah, wow.
20% per annum dividend growth.
Yeah.
I mean, what's Zip's compounding dividend rate?
Well, infinity. Or not
what's zero number? Divided by zero?
So I don't know. We need like quantum computing to calculate that one. So number 2, what is the company inside the ASX 20 with the fastest growing earnings per share or profits per share over 10 years?
Over 10 years. Can I? What's in the ASX 20 now?
That's probably a good place to start. So while you get that up, I'll give you another hint. If anyone listening, it starts with the letter A. It starts with the letter A.
10 years ago was 2014. Well, that made it easy, didn't it? Afterpay.
I'm just taking the ASX 20 today. So what of the companies of the companies in the ASX 20 today.
Aristocrat Leisure?
Yes. Aristocrat Leisure has grown.
Well, you made it easy. You had a 5% chance, and there were only 3 that had started with A. So. And Afterpay doesn't exist anymore. And it wasn't ANZ. So that
26% is how fast it's compounded. Yeah.
And that kind of comes from the fact that it was a mid cap. And that's probably the story that Dion went through as well, that this company was a mid cap 10 years ago, and it's compounded at 20% every year to now become one of the 20th biggest companies in Australia.
This next one's going to be interesting. So this will be at the lower end of the ASX 20, I think. Which is the company with the fastest growing sales over 10 years? So this is the ASX 20 today. So yes, it would have been a mid cap, or maybe even smaller than that, actually.
20 years.
10 years.
10 years.
But in the ASX 20.
REA.
Close. Similar type business, I guess,
Car
in a way.
sales.
WiseTech. Yeah. Next one is, what's the company with the highest return on capital? ROIC. Obviously, it's not going to be the banks because they have a lot of debt, which skews the ROIC.
Nothing with leverage. Oh, BHP for sure.
Or something that's gone from leverage to not as leveraged.
BHP, surely.
Fortescue.
Oh, close, yeah. Mining companies.
Yeah, because we're at the cycle, right?
Just pump out profits.
Yeah, so Fortescue ranks really highly. Now, what's interesting, if you go down to the ASX 100, the company with the highest return on capital is actually your friends at GQG. I don't know why I call them your friends, but let's go with that. But that's an example.
In my portfolios, and they've delivered. So
that's an example. If you go to ASX 200, it's to Terra Royalties, which it does royalties. I think it's for like miners, for everything.
Yeah.
So you broaden your horizon. It gets quite interesting. But what I found that when I looked at the numbers, I looked at the dividends per share over 10 years, the earnings, the revenue growth, the return on capital. But I looked at it across all of the different segments: ASX 20, 100, 200, the 200X, the 20, the 300. And what is interesting is, obviously in the ASX 20, you're getting consistent dividend growth. You're getting consistent dividend growth from the ASX 20. But the realities are that the sweet spot for revenue growth is in the ASX 200. And the sweet spot for return on invested capital is actually in the ASX 100. So as they go from that growth phase in the ASX 200 and 300, and they kind of push up into the ASX 100, is where you get that inflection in terms of their profitability. Kind of where Zip might be in a year from now if they do this paying 8. Who knows? It's $3 billion, Drew. It could be an ASX 100. It probably is in the ASX 100. That's a crazy thing. But I think that's kind of I think you've answered. It was quite a long question and name, but I think you kind of answered their Pop's question here when you said that you kind of blend things together. I take a similar view. We're thinking of blending X20 in with our VAS position because it does make sense, particularly now.
So it might be like 60% in VAS and then 20 in mid and smalls, or 70 and 30, but it depends on your risk profile and what your objective is.
And also, I think it also depends on your time horizon, because a lot of people can crunch these types of numbers in a spreadsheet, but then the reality is you don't want to be you're dealing with retirees most of the time in a zero tax environment or a very conducive tax environment. Whereas if you're an accumulator, you can't just chop and change because you pay heaps of tax as you go about your business. So you've got to view it with a long-term time horizon. You've got to say, well, if you invest in the X20 funds, what you're actually not getting is when WiseTech goes from number 1 in the X20 and then graduates into 20 and then gets removed from the fund. So you actually miss out on that upside. So you've got to be aware that you may not get the return that you think you're getting. So with an active manager, you might. Drew, in the interest of time, maybe pick your favorite report that's come up, maybe one of the headlines, even if it's not a result from a company, but maybe just pick something that came across your desk this week, and then we'll just answer a couple more questions.
Other than NVIDIA? I think we kind of covered NVIDIA pretty quickly, didn't we?
Yeah. Good stock. Buy it now, says Drew. Next.
I mean, inflation came out hotter than expected. And probably an interesting one would be Tyro. So we can stick with kind of Zip, Tyro Payments. They're actually like my favorite terminal. No, like I'm not.
You have a preference for terminal. So when you rock up to a cafe and you're like, oh,
they just seem to work. Like they're the big screen, aren't they? Like or are they maybe
that's Square, bro.
Oh, that's Square. All right, wrong one.
Change.
Sorry,
Never mind, Tyro. But thank you. No, Tyro is David Thodey, former Telstra. I think he's the chair of Tyro, or was, or something like that. Yeah.
So they had a pretty good turnaround. Profit, they really struggled, and probably more competition than anyone ever expected in that sector.
Definitely.
That anyone can put a payment tag up and get it to work, and no one really looks that much at how much the fee is anymore for some reason. You cut your soy latte with honey is just $7.50. And if they add 40 cents to it, well, most people don't notice until after they've already paid for it. They had a reasonable result. Similar numbers to Nvidia. Four times increase in profit. That's a quadrupling of profit to not the same scale. 25 million for the financial year.
I've got to admit, this is the second time you've said this is like Nvidia. You said that with Zip, and now you're saying it with Tyro. Which
it's probably evidencing how hard it is to grow.
You're stretching, right? It's like similar, no same.
It just shows you how hard it is to grow at a similar rate.
Earnings
was up 30%. I'm just saying that Nvidia is growing. Like, it does put into context what Nvidia is doing. Like doubling your revenue every quarter based on the previous year. That's massive. Tripling your profit. Huge. Like and when a company like Tyro is doing 4 times, but it's at a profit of 25 million, the scale is just completely different. And there's probably another question you're going to sneak to, which relates to that too. So, but it was a pretty good result. Shares went up like crazy. Obviously, it's similar to Zip. It's been a very difficult period in a highly competitive transaction and kind of payment terminal environment.
Well, let's set some context here. Tyro is coming off a very hard few years, as you've alluded to. And one of the reasons for that is not just competition, as you alluded to. There is another reason, is that I can't remember if it was 2021, 2022, like post-COVID. What actually happened is Visa and MasterCard increased their interchange fees. They're basically the fee that you pay when you tap your card. And Tyro didn't pass that fee on.
Yeah.
So they effectively said all the merchants, because it was so competitive to put a payment terminal in a cafe or a restaurant or wherever Tyro is accepted, because it was so competitive, Tyro couldn't keep increasing the costs that it was getting pushed by these big payment networks, because it needed to win more customers. So it just kind of copped it, and meaning that its profit margins got cut dramatically. In the middle. So that just comes back to, I think, if you're an investor in these types of businesses, is doing the Porter 5 Forces exercise, which is where you look at a company's competitive position from 5 different perspectives. And what it basically would show, if you did that properly, what I think it would show is that Tyro is a price taker from Visa and MasterCard, as is basically the whole entire universe, to be honest. So it's just understanding that dynamic and the power that the suppliers have of those payment networks. Obviously, if you're running over FPOS, it's pretty good, but the big global payment networks, whatever they say goes. RBA has some say in that, but not to a great extent. So, Drew, we did get some questions sent in, and there were some really good questions and a couple from last week that we did not get to. Maybe we'll start with Jeremy, who sent in a question: invest in ETFs from Super and choosing international ETFs over VAS due to the US being the king of the market. Maybe that's what we should have made the title of the podcast: King of the Market.
King of the Market.
Is the US the king of the market? And I think this might relate to your point about NVIDIA and the broader conversation around what drives the US market. Do you think it's a case of US or Australia, or US and Australia, Drew?
I think it's like, I'm pretty boring on this. It's value and growth. It's active and passive, and it's US and Australia and rest of world. But just looking at, Tyro, Zip, Afterpay, our biggest 20 businesses, compared to NVIDIA, it's just another story.
Our biggest 20.
And our biggest,
you weren't putting Zip and Tyro in that. Just like, wait, what?
I can already see the title: Zip equals NVIDIA. I think there's just this massive difference in quality. Like we've probably got 3 or 4 global standout leaders: CSL, ResMed, BHP. Would be like 3 Australian true global leaders. But as soon as you go to the top 10 stocks, the S&P 500, Apple, Amazon, NVIDIA, Facebook, Tesla, you've just got globally dominant franchises and businesses. And that's I think you don't need one or the other. You need a portion of that in your portfolio, because these are the companies that are going to drive where economies go, where money goes, and what consumers spend money on in the next 10, 20, 30, 40 years. So I don't think it's one or the other. I think, yes, the US is by far king of the market, particularly around technology, consumer, all software, all those sort of areas. But we also have, we don't do too bad ourselves. We have a nice immigration tailwind, and we have a free kick in a thing called franking credits, which makes it relevant to holding both. And most retirees need both income and growth, as we know. Don't want to restate another golden rule again.
So many golden rules. How many golden rules are there these days?
10.
Okay, that hasn't changed. Just
got to keep it even.
So Damien did write in and asked about an ETF spreadsheet, one that we shared a little while ago. Damien, just shoot us a message in the Rask community. There should be a link in your podcast player. Just jump over to community.rask.com.au. And I think I know the Excel spreadsheet of ETFs you're talking about. Just let me know and we'll send that to you. Now, as for the US versus Australia, I agree with you, Drew. I think it's US and Australia. I think the franking credits are really important. And as we just discussed, you can exclude the top 20 if you don't want to have as much exposure to that part of the market. You can use active funds. You can pick individual companies. You can cut it up however you like. Yeah, sure, the US is the king and the queen of the market, probably, let's be honest. You got to have some exposure to it. I think you just got to be sensible in how you go about it. A lot of people are calling the top of the US market, which seems a bit ridiculous to me.
Every day.
Yeah. I don't know if people get more scared on the way up or the way down. I nowadays, I think people are more often scared on the way up, but they get more scared on the way down, if that makes sense. So like most people say to us on the podcast, like, I'm scared the US market is at an all-time high. Those are the same people that would be more scared on the way down. But that's something that we hear all the time. So yeah, anyway. Okay, so Drew, there was a question sent through last week, and this was a really kind of like interesting one from a financial plannery type perspective. It was from Sync. And they said, question for the two wise doctors, Andrew and Owen. Put me in that bucket. Interesting. A long-time listener here, no partner, no kids. So they're giving us a bit of their situation, Drew, which we've got to be careful about because we can only offer general financial information on the show. However, we have absolutely no idea who this person is unless they're called Sync. So let's just make that very clear. They say so many financial podcasts /newsletters /write-ups give scenarios for couples with younger kids in their 30s or couples with older kids in their mid-50s. Here's a twist. Why don't you give us a hypothetical for your single listeners that don't have kids? I think they're called dinks, not sinks. Do not intend on having kids. Isn't that what it is? Dinks? Correct me if I'm wrong here. I'm not up to date with the lingo.
Do not intend having kids.
Yeah.
Dinks?
Yeah, anyway.
Don't. Yeah.
Don't intend on having kids. Dinks. I'm pretty sure that's what it is. Anyway, here's a twist. Make something for single listeners that don't have kids. Let's say that a person has been wise and paid off their home. They probably have an investment property or they've got some loan against that. They've got like average super and all the rest of it. What would the wise guys, that's us, to the sinks, say to the sinks if they have a bit of extra moolah each month? Like what would happen? How would someone's situation and their financial plan change in that scenario? So would they do something differently if they've got their mortgage paid off? Could they take more risk, less risk, Drew? How, just generally, like we don't have to give them specific answers because we don't actually know this person, but what would be the process that you would go through to consider how that strategy might be different to a typical couple with kids?
Yeah, I think you just have better transparency on your expenses. Like children come with uncertainty around expenses, around when things will come up, around schooling, and with additional costs. And you've also got ultimate, significantly more flexibility. Not that you don't have flexibility when you have children and a family, but you're in a position where you can take more risk. So what you generally say is you can probably accelerate your investing, but you want to look at what your objective is. So if you're in a strong position already, do you want more flexibility and the ability to pursue other career paths sooner, in which case you might not want to, do you want to keep saving and just have a pool ready to go? Or if you're comfortable what you're doing and you can pile away and do something like a debt recycling strategy, where you're starting to pull money out of your mortgage to invest to start building that passive income pool at the same time.
So basically what you're suggesting, if I could loosely summarize this, no, it's good. It's a good answer. So what you're basically suggesting is it really doesn't change the overall strategy. What changes is the income and expense ratio.
Probably a risk profile,
yeah, and a slight tweak to your risk profile, because you don't have the expected liability of kids,
school fees or
currently or in the future. You could probably you have probably a bit more freedom because your living expenses are lower. And in this hypothetical scenario that they've given us, they paid off their mortgage. So they don't even have a mortgage or kids, which are typically the two highest expenses that anyone has to pay. You don't have to go and get a Kia Carnival. You can just bump around in a Barina or something, bit smaller. So you probably got less costs in that respect as well. So then what you're saying is, okay, once you just have that general gist, you could then decide, do you take, medium-term, long-term goals, like 5, 10, 15-year goals. And maybe your goal is, okay, I've got my house paid off, but I want $3 million before I retire. I'm going to go, just go for it. In that case, you might have to amp up the risk. You might do a debt recycling strategy where you redraw money out of your primary residence, put it into an investment portfolio or a property, and you dial that up a bit. But if your goal is not that, then you don't need to worry. And you could probably just happy days, basically. But most singles, I got to say, when I speak to most singles about their financial situation, like generally speaking, it is not like this. It is not like a house paid off, investment property, got some cash, good job.
Very hard to buy a house as a single as well in Melbourne, in major capital cities.
Yeah. Like that's the hardest bit, because you don't, because there's a lot of those schemes for are built for couples. And Chris Bates says this on our property podcast all the time. He said the financial world is built for couples. It's just the reality of it. Like household incomes, like borrowing capacity, when you go into one of those calculators, you can put in your partner's income. Like that's the way they're built, unless you're living in a throuple, which means you might need 3 spaces to put your income in. I think those are less common, just as my understanding of that whole situation. But you're spot on, Drew. It's actually getting to the point where you have that inertia as a single person, because a lot of the times you do end up in an apartment or a smaller property, which doesn't have the flexibility in terms of debt recycling, or redrawing equity doesn't grow as fast. You're competing against buyers that do have 2 incomes. So there is considerable trade-offs there. But on the other side, once you do hit that stride, you probably have more flexibility.
Yeah, 100%.
We've probably only got time for one more question, but we do love your questions, so please keep sending them in. And if you're going to Wattle Day, or you were at Wattle Day yesterday, I'm sure you blitzed through with all these interest rate predictions, so we can save that for next week for the rest of us. There was this one here: breaking beta sponsored chess gun. Should I be worried that Betashares Direct is not chess sponsored? And how do I get a list of all of the investable ETFs on their platform? So, full disclosure, Betashares is a sponsor of the Rask Australian Finance podcast. And they recently announced an investment platform called Betashares Direct. The questioner said that they are not chess sponsored, so they do not offer a holder identification number, which a lot of people in our community like, at least. And they say, how do I get a list of all investable ETFs on their platform? I'm pretty sure, I could be mistaken, I haven't got it in front of me, but I'm pretty sure all ETFs are available on the Betashares platform.
Yeah, with zero brokerage.
Yeah, with zero brokerage.
I don't know a lot about it. I'm assuming it's like similar to a managed account. Yeah.
I think that's kind of the underlying structure.
Platform. Yeah.
Yeah. And yeah, it's obviously a lot of people find it appealing because it's effectively got no brokerage fees. And it's kind of a modern platform, and it seems quite really cool for a lot of folks who are looking at it. But I don't actually know. I should actually know this off the top of my head because they are a sponsor. So apologies, Meredith. But I'm pretty sure it is all of the ETFs, but I could be mistaken. I'm pretty sure it is all of the ETFs. And for what it's worth, I would hope that it is all of the ETFs, because that does build a lot of, in my opinion, it kind of builds integrity and trust into the system. Because if you have an ETF provider that provides their own investment platform, it kind of seems a bit, I don't know, you got to really consider is where are the fees getting paid? Who's paying what? For what it's worth, I don't mind paying brokerage fees. I think people that start there probably should really check themselves at the door. And if that's the most important thing should be, does the platform make me a better investor over the long term now? But they say 350 plus ETFs, Drew.
Yeah, exactly. I mean, I think it covers most of the market, and it's just an online investment platform. And we know from looking at reports of other platforms, usually the way that money is made is through cash accounts attached to a platform. That if you're not charging brokerage, there's some sort of margin being made somewhere else. And it looks like it's because it's not. I just looked at the PDS quickly, and there's fractionalized investing. So they're custodial entity, and then splitting the ownership of all the investments between all the unit holders, which is completely similar to other platforms. With the custodian at the highest level, make sure everyone's investments are appropriately allocated.
Yep.
But just limited to ETFs, so like a very narrow platform.
Yeah. So whereas the platforms you're talking about platforms like NetWealth,
Hub24.
Yeah. So what I was going to say is that Vanguard does have a similar platform, but one of the things that they do, if I'm not mistaken, and it's Vanguard, I do apologize if I'm mistaken, but it's Vanguard has different fees that apply for different funds. So if you buy their funds, you get them with no brokerage, I'm pretty sure, versus if you buy another product provider's ETFs. Now, I could be wrong on that, but I'm pretty sure that's how it was when I looked at it last time, which I don't actually think is, I actually don't like that. I'm just going to say it like it is. I don't actually like that, because if that's the case, then it's kind of like we're presenting an investment option for you, but hey, if you take our option, it's different to if you take someone else's. Now, so they don't have to do that, of course. They can do whatever they want, but I just think it kind of should be either a platform for everything, or and everything's treated the same, or not. That's just my personal take. It's not, they're allowed to do whatever they want, but that's just how I feel about it.
Yeah.
Drew, you do have to serve us up a dad joke, but in the meantime,
I'm ready for once.
Okay. What I would say to these folks is send in your questions. There's a link in every podcast player episode. In every podcast player for each of our episodes, there is a link that says ask a question. You can also head to the Rask Media site, and I believe it's under the help drop down in the menu, or it's under the experts thing. It says ask a question. You can click it there too, and basically just ask a question, select the Australian Investors Podcast or whatever podcast that you listen to at Rask, or even the live show, and we'll answer your question. Do keep in mind that we do like to keep it general, because that's what we have to do, and also it's a bit of fun, so keep it lighthearted. We do give away a value investor program, which is a $499 course for anyone that asks a question and gets the funniest name. I get to select that because Drew does the jokes. I am going to go with the first person that asked a question. I did not pick up on the reference whatsoever, which was "You Can Call Me Pop," which is a Bad Boy Bubby reference. I think Drew got that one, but not me. Sounded like it was funny though, so you can get the Value Investor program. Just write into us and say it was you. Another thing before we get to Drew's joke is that if you do want to become a financial planning client, let's say you want to become a client of Waddle Partners and you want to go to this thing called Waddle Day and get absolutely no investing wisdom, but lots of wine, you can become a Waddle Partners client or a client of any of our trusted advisors by heading to the link in your show notes that says financial planning. It was a bit of a joke. Obviously, there's a lot of investment wisdom that's given out at Waddle. Just not at Waddle Day. That's the one exception of the year. This is Christmas. No, but seriously, if you want to get financial planning advice, retirement, whatever that's there. Oh, Drew, actually, we didn't mention something. You guys were recording the retirement podcast this week.
Good to go, ready to launch. I think first couple of weeks of September.
Yes, first weeks of September. The episodes for the Australian Retirement Podcast will be launching. We've got the Honourable James O'Reilly from Northeast Wealth and Drew Meredith, CFP, Director of Waddle Partners Financial Planning.
CFRP or retirement planning or something, don't we?
Yeah, we need a different. We should make our own one up and then charge everyone to get it. So Drew and James are hosting the Australian Retirement Podcast, and I will put a link in your podcast player if you do want to access that. Episodes start dropping in the next 2 weeks. The guys are going to be answering questions every week. We're going to have people write in and share their story of retirement, things that worked, things that didn't, experts, you name it, it's going to be on there, and it's going to be great. So first episodes have been recorded. They're going to drop in the next 1 to 2 weeks probably. So go and subscribe on Spotify, Apple. It's also available on YouTube. There are some episodes sitting there with Drew and I, but they will be replaced by these new episodes when they come up. Drew, take us off into the sunset. What have you got for us?
Well, it's Father's Day tomorrow, so I thought I'd bring out a Father's Day joke.
Good reminder.
Yeah, and this could be a true story. Who knows?
Hmm.
My dad said he wanted something groundbreaking for Father's Day.
Did you buy him a shovel?
You got me.
Oh, I got it.
You got
really?
it. You got
it.
Yeah. You got it. That was
That's
it.
the first one I've ever got in the however many years we've been doing this. I was just thinking, what breaks the ground? I'm like,
it wasn't even a question. You just interrupted.
A shovel doesn't really break the ground, though, does it? It kind of cuts the ground.
Moves the ground. Yeah.
Moves the ground.
Close enough. Let's not get too technical.
Okay, so groundbreaking shovel. Got it. Okay. Wow.
Yeah.
Wait, that's the first time. I'm going to give myself one of that. I've never ever got one of your jokes. That's the first time. Gosh.
Look at you. That's chuffed.
I'm so happy with that. That's made my day. Well, Drew, this has been heaps of fun, mate. Always a pleasure. Good luck with Waddle Day tomorrow /yesterday/
future.
Yeah, future. But mate, always a pleasure. And thank you everyone for listening.